So we need to pay attention to what interest rates are doing with inflation combined with S&P 500 earnings to see what the market is actually going to be able to do this year. What's going on, everybody, and welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. Please like, please subscribe. Make sure you hit that notification bell so you can be in the know every single time that I drop an episode. Now, in this episode, we're going to be talking about the S&P 500 and how the market is going to be reacting to certain data points. This is actually a very important week in the stock market. We have just received PPI inflation data today, and we're expecting to receive CPI inflation data on tomorrow. That's Wednesday, January 15th. Now, full disclosure, I am recording this episode on January 14th, but I'm going to be giving you some guidance and some information to look at based on what the CPI data could be in the expectations. In addition to that, we do have some earnings. We have JP Morgan and Chase coming out on Wednesday, January 15th. We have TSM coming out on the 16th and other banks reporting this week. So earnings season is just beginning. That's going to be affecting how the S&P 500 is going to be moving. So let's go ahead, let's get into this episode, and let's talk about the things that I know that we need to pay attention to for the market to go higher or lower. Okay, so let's go through this article, and this article is talking about the Producer Price Index, PPI for short. The Producer Price Index measures the wholesale prices on producers in the economy, and wholesale prices rose 0.2% in December, less than expected. Okay, so let's go through the article. A measure of wholesale prices increased less than expected in December, providing indication that pipeline inflation pressures eased to close the year, though likely not enough to provoke another Federal Reserve interest rate cut anytime soon. The Producer Price Index rose just 0.2% on the month, less than 0.4% increase in November, and below the Dow Jones consistent estimate for 0.4%, according to a Bureau of Labor Statistics report on Tuesday. So that's good. It's good that the inflation reading that we got was lower than expected. Excluding food and energy, the so-called core PPI was flat compared with the forecast of 0.3% rise. Excluding food, energy, and trade services, the measure rose just 0.1%. On an annual basis, headline PPI rose 3.3% for the full year, well ahead of the 1.1% increase in 2023. So when you talk about that core, the core strips out food and energy because food and energy are very volatile and the prices can change very drastically from month to month. So you want to look at inflation not only from a headline, including everything, but also stripping out the volatile food and energy. Now, goods prices increased 0.6%, pushed by a 9.7% surge in gasoline prices. Upward moves in several food and energy related measures were offset by a 14.7% slide in prices for fresh and dry vegetables. On the services side, prices were flat, despite a 7.2% increase in passenger transportation that was offset by a fall in prices for traveler accommodation. So the stock market futures, though the stock market futures had shot higher following the report, while Treasury yields moved lower after pushing sharply higher in the early days of 2025. So we're talking about stock market futures. We're talking about the futures for the market before the market opened on Tuesday, January 14th. That's what we're talking about. And the Treasury yields moved lower in the pre-market, okay? The release is the first of two key inflation readings this week that will likely figure into the Federal Reserve's interest rate decision later in January. On Wednesday, the BLS will release its more closely watched reading on the Consumer Price Index. That is expected to show 0.3% monthly gains on both the headline and core readings, and respective annual inflation rates of 2.9% and 3.3%. Now, though the central bank focuses more on the Commerce Department's personal consumption expenditures price index as its main inflation gauge, the PPI and CPI readings figure into that calculation. Markets pricing in overwhelmingly points to the Fed staying on hold at the January 28th to 29th meeting. However, policymakers and Chair Jerome Powell in particular could lay the groundwork for what is ahead as far as rates go. Fed funds future pricing Tuesday implied just one rate cut through the rest of the year. Bank of America economists on Monday said they think the Fed could be done this year. Fed officials at their December meeting penciled in the equivalent of two cuts this year, assuming quarter percentage points moves. Now, all of this is a lot of information, but what do I really want us to take away from this? What I want us to take away from this is that the Federal Reserve is probably not going to be lowering interest rates as much as what we thought, unless the economy heads for an unexpected downturn. As of right now, based on the data is strong in terms of the economy. The only thing that we need to make sure is we need to make sure that inflation stays in check. We do not want the economy to be strong, but inflation expectations to be rising. Because if that's the case, then asset prices, stocks can fall. And that can be something that we do not want. And so we need to pay attention to what comes out with CPI and pay attention to that and see how the market reacts to that particular report. Because CPI is more of a market mover than PPI, even though PPI is very important. Okay, so this is marketwatch.com, and I like to go to marketwatch.com because marketwatch.com will provide you the U.S. economic calendar, what data is expected to come out this week, which is very, very important so we can see the certain expectations. So Wednesday, January 15th, CPI is going to be released. Now, in this column, we've got the median forecast, and then in this column, we've got the previous forecast. So the forecast for CPI, Consumer Price Index, measuring prices for consumers, 0.3% month over month, 2.9% year over year. Core CPI, stripping out food and energy, 0.3% month over month. Core CPI year over year, 3.3%. Now, what were the previous readings? The previous month over month in December was 0.3%. CPI year over year was 2.7%. Core CPI 0.3% month over month and 3.3% year over year. So this is showing us that inflation year over year on CPI is expected to be higher than what we had last month, and every other reading we are expecting to be flat. So what does that tell me? That tells me that we cannot get to a situation to where inflation is actually higher than what we are expecting, and that happens throughout the remainder of the year. Because if that happens, then that means that the market's going to be pulling back substantially, because we cannot afford to have a situation to where inflation expectations are higher than what we anticipate. So we have to pay attention to this as investors and as traders. All right, y'all. So let's go ahead and get into the charts. Now, the first chart I want to show you all is the 10-year Treasury note. Now, what is the 10-year Treasury note? The 10-year Treasury note is a bond, okay? It's a bond, right? And so over that 10-year Treasury note, that 10-year Treasury note has a certain inflation rate, has a certain coupon rate, meaning that you can purchase that particular bond. Okay, you purchase that bond, you let the United States government hold your money for a 10-year period. The United States government will give you that coupon rate, every year over 10 years. And then at the end of the 10 years, the United States government will give you that money back. Now you can purchase 10-year notes, like you can literally purchase 10-year notes, or you could just purchase an ETF that tracks the 10-year note and receive yield, things of that nature. Now, the one thing I want to tell you is that the 10-year note is a very widely followed benchmark in the financial world, and it's used to gauge economic conditions. Rising yields often signal expectations of economic growth and inflation, while falling yields may indicate economic slowdown or risk aversion. It's also used to set borrowing costs. So it's a reference point for interest rates on other financial products like mortgages, corporate bonds, and loans. So we need to watch the 10-year note because economic sentiment fluctuations in the yield reflect investor confidence or concern about economic decisions. So we have to pay attention to what this 10-year note is doing. And as we can see, the 10-year note is rising. Now, the 10-year note is at 4.788%. So this is Thinkorswim, and Thinkorswim is showing you 47.8. Well, if you just move your decimal place one over, that will give you the inflation rate for what the 10-year note is trading at. Now, the 10-year note is actually above the high point of where the 10-year note was back in April, and is getting close to where the 10-year note was back in October of 2023, right? So let's take a trip down memory lane. Let's go all the way back. Let's go back as far as we possibly can, and let's see where the 10-year note was even as higher, right? We have to go back to June of 2007. We got to go back to July of 2006 to see the 10-year note above 5%, right? So the 10-year note is moving higher, right? The 10-year note's moving higher. So let's go back to the daily chart, okay? The 10-year note is moving higher. If the 10-year note is moving higher, that means that investors are selling bonds. They're selling bonds because the yield is moving higher. You have the ability to get a higher yield because investors are selling bonds, saying that they don't want them. The demand is low. If the yield is coming down, that means investors are buying bonds, okay? Meaning that your returns in bonds will be better because the demand is there, okay? The one thing I want us to understand about stock market performance in the S&P 500, what can the S&P 500 do depending on what interest rates do? If interest rates stay relatively higher, but inflation expectations are lower and S&P 500 earnings potential is higher than expected, then the stock market can continue to move higher. But if interest rates stay higher and inflation expectations are higher than what's expected and S&P 500 expectations are lower than what's expected, then the stock market is going to move lower. So we need to pay attention to what interest rates are doing with inflation combined with S&P 500 earnings to see what the market is actually going to be able to do this year. Okay, so let's go ahead and look at SPX, the S&P 500 index. Now, the S&P 500 index got as high as 6,099.97. That's what it got back in December. That was the high. That was the high. But since that time, we've not been able to make another record high. We've actually been making a series of lower highs and lower lows. And we're at a situation to where the S&P 500 is below the 50-day moving average, and it could be making lower lows if it continues to go on this particular trend, right? If we take a look, okay, so this right here, this is a daily chart. Okay, this is a daily chart. Well, what I want to show you is that the trading year started on January 2nd, 2025, and we opened at 5,903.26. And so as of right now, we are lower on the year. We made a high, but we have not been able to break above this high, and we are lower than where we started on the year. So what is that telling me? What's that telling me is that in the beginning of this year, we are on a downtrend right now, and we need to see the market break above this before we can say that the market is on an uptrend. But again, what did I talk about? We need inflation expectations to be lower than expected. We need S&P 500 earnings to be higher than expected. And that's what's important. I think earnings are going to be good, but we have to watch the inflation. We have to watch the inflation. That's going to be affecting the stock market. We need to pay attention that if inflation expectations are higher, then technology may not be a winner. Consumer discretionary may not be a winner. Communication services may not be winners. We may need to be looking into other sectors like energy and healthcare. And so we need to track this very, very closely. This is not something that we need to be alarmed by. As long-term investors, we honestly do not care. We're buying every 2 weeks, we're buying every month because we're long-term investors. But as traders and as people that are tracking the market daily, we need to be paying attention to what's going on so we can position ourselves to be on the right side of the trade. So again, I appreciate you all for another episode of the Trade for Yourself podcast. Okay, please like, please subscribe. Let me know what you think about my explanation of the S&P 500, interest rates, inflation expectations, 10-year yield, the whole 9 yards. What I want you to understand as traders is that we have to be paying attention to economic activity. Economic activity and economic expectations can actually gauge the way the market wants to trade. And so you have to pay attention to those things that are happening to know what levels to look for and be able to identify a trend. Understand that we have earnings season. Earnings season is starting up, and we have to see if earnings can be better than expected so the market can at least have the earnings on its side to have that potential to move higher. As always, remember, don't pay for it. Trade for it. I'm going to tap in with y'all in the next episode.